Hello and welcome. You're watching Know Your Company, our special show on the NDTV Profit with me, Somit Sarkar, and my co-anchor Puneet. Well, today the company that we have on KYC is Netweb Tech. So firstly, let's understand what are the key questions that we would want to know from the analyst and from the management when it comes to Netweb Tech. Firstly, whether the growth guidance that the management has given, is it sustainable? Now, earlier the management had guided for a growth of around 30 to 35%. So is that growth sustainable even for a longer period of time is something that we would want to know. When it comes to order wins, the company has announced mega order wins in this month, that is in September 2025. So what are the further order wins that we could see when it comes to AI infrastructure is also something that we would want to know from the management and from the analysts. How are they looking at? When it comes to its partnership with Nvidia, how does this partnership helps the company? Does it help them does this help them secure more larger orders going forward is something that we would want to know from the management. And when it comes to what is the view of the analyst on the current valuations, given the sharp run-up that we have seen in the share prices, are the valuations sustainable at current level is also something that we would want to know from the analyst. And lastly, these two order wins that the company has announced will suffice growth or will suffice strong growth for the company till FY27. But what happens to growth beyond FY28? That is something that we would have to know from the analysts that will be joining today on Netweb Tech. But first, let's start with Puneet on what does this company actually do?
Well, definitely it's one of the most interesting ones because it doesn't actually have a direct peer, to say the least. It provides high-end computing solutions, which essentially means they do provide supercomputers for various applications in key industries, and we'll get to the industry part in just a bit. It deals in fully integrated design and manufacturing capabilities of these computing solutions, and because of that, the supercomputers have appeared 15 times in the top 500 rankings as well. When you look at the other key aspect, which is the key segment, and they divide that into 5 key operating areas. Computing is one, private cloud. These are the two main ones that we watch out for because that's almost 70% of the company's revenues. The third includes AI systems, and you'll see that the revenue is actually doubled over the last 2 years for the AI system category. It is a new one, to say the least, so we could expect some higher growth in this particular sub-segment. Fourth one, storage, and the fifth one is data centers. Now, data center actually has a huge applications. The company used to manufacture servers earlier as well, but because of the high growth segment in the first two ones that are mentioned on your screen right now, we've seen the contribution of data center actually be in just some low single digits as well. But that's largely the top 5 segments that Netweb Tech operates in. It's important to know which industries they cater to as well, because a lot of industries which require high computers and high super solutions as well are clients of Netweb Tech as well. So if you can look at the industry classification as well, that's the other one. We've seen space and defense be roughly about 28%. ITTS is the other one, which is the majority of the company's share. Education and research as well, and the other enterprises is the other industry as well. It has a lot of clients, especially from the government side as well, that do cater into these segments that they operate in, but that's largely on this company's industry that they cater to. Very quickly, I just want to highlight the other data for Q1. Revenue from repeat customers is roughly about 72%, and that because they are such high growth customers that you would have repeat orders from these ones. The other ones, 23 new clients that got onboarded across the industries in Q1. Pipeline is over 4,000 crores for the company because of the scope that it offers and no direct competition essentially as of now, at least in the listed space, with an order book of existing about 229 crores. So the difference between the order book to the pipeline is also quite sustainable and quite huge. So it could materialize at least in that space as well. They also had a recent order win of 415 crores. That's to supply Tyron AI GPU accelerated systems, and that we are going to talk about that with the analysts as well as with the management as well, and that's deployment of AI infrastructure as a whole. But that's largely about the company. We've told you about what we actually want to know from the analysts as well, but let's now look at the metrics, Amit.
Well, yes, the first, there are total 8 metrics on which we are going to rate this company, that is Netweb. The first one would be income statement, followed by balance sheet, then the cash flow, how the return ratios for Netweb Tech, shareholding pattern, what has changed over the years, street cred means how the stock has performed over the last few time frames, how the valuation standing, what's the street coverage, and what is the outlook going forward for Netweb Tech. So based on these 8 parameters, we are going to rate Netweb Tech in the next 10 minutes. So firstly, when it comes to income statement, If you look at the company's income statement, the growth has been quite strong. 67% is the CAGR growth that we have seen over FY22 to FY25. For 65% similar growth coming into EBIT, and similar growth that we are seeing when it comes to net profit. Net profit CAGR growth has been around 73%, and over the last 3 years that we have seen, margins, if you look at the EBIT margins of the company, that has remained in the range of around 13 to 15%. So not much of a deviation, strong level of margin, strong growth that we have seen in the last 3 years. Now if you look at the first quarter performance, the first quarter of FY26 performance for Netweb Tech, on a sequential basis, yes, it has declined 27%. But then again, this business is largely dependent on how the order wins cycle are. And if you look at YOY basis, yes, again, a strong growth is what Netweb has reported on a YOY basis. 102% growth in revenue. EBIT has increased by 141%. Margins expanded by around 221 basis points to 13.8%. Net profit came in at around 30 crore, which is a jump, which is nearly double of what the company reported last year. So again, a strong growth on a YOY basis in the first quarter as well. So thumbs up that we are giving it when it comes to the income statement for Netweb Tech.
Well, balance sheet also likely has seen strength as well in this particular time frame. We've given this a thumbs up because if you see the movement essentially of the book value, just from roughly about 93 crores in FY23, the book value has now inched up to 530 crores in just the last couple of years. So it's definitely a key positive. In this particular time, the company has reduced its borrowing. That's helped contain profits as well. And the cash and bank has also increased to roughly about 222 crores in FY24. We saw a slight dip from those levels to 180 crore in FY25. But the jump essentially from FY23 compared to FY25 is so vast and so huge that it's a clear thumbs up on balance sheet metrics as well. Cash flow, Somit.
Right. Now, if you look at the cash flow here, yes, the operating cash flow has come down. 27 crore is what we had seen in FY23, which has come down to negative 13 crore. But as a percentage of PAT also, it has reduced. But on a net basis, if you look at, the company has still been generating cash, given the fact that there are multiple other sources for the company to get cash here. If you look at the complete statement here, there are cash flows from financing and investing options as operations as well. So on a net basis, yes, the company has been generating cash. So on net cash flow, it has remained largely stable in the last couple of years, around 83 crore. However, given the fact that operating cash flow has reduced because of the increased number of receivables, we are giving it a neutral rating as of now.
Now, when you look at the other key metrics, which is return ratios as well, because that is the other important one. While FY23 was a strong year at about 47% in terms of return of capital employed, the reason we are giving this a neutral rating is largely to know what could be the stable run rate for the company. Is it going to be 28 to 25%, which we've seen the last 2 years? That's going to be one key question. On return on equity as well, when you look at the other metric, was roughly about 45% in FY23, FY21. FY23 saw a huge jump to 68%, but we've largely seen a stable 25 to 29% in terms of return on equity as well. So we've largely given this a neutral rating, being very conservative on our ratings, and that's largely because of lack of stability, if any, over the last 3 to 4 years. It is a high growth company, so we've given this a neutral largely because of that aspect and to know what could be the run rate going forward as well.
Right, and when it comes to shareholding, again a thumbs up that what we have given, because the promoter holding has remained largely stable over the last 1 year. FI holding has come down a bit, but again not much of a decline, just 100 basis points of a decline. DI holding has also declined by around 100 odd basis points, but again public holding has increased by similar number from 13% has increased to 15 odd percent, but promoter holding has remained largely stable. Again 70% plus promoter holding is quite positive when it comes to Indian companies, and hence a thumbs up that we have given for the shareholding part.
When you look at the street cred as well, and there's not too much to complain here, honestly, because just in the last 1 month, the stock's up almost 59%. When you also look at, longer time frames as well, essentially in the last 6 months, it's almost up 135% in terms of stock returns. On a year-to-date basis, we have seen some knee-jerk reactions, but still up 26% and largely outperforming both the Nifty as well as the mid-cap performance. 43% on a yearly basis. So this is no doubt we've given this a thumbs up. Very strong profile in terms of stock returns that the company has given in this particular point of time.
Right, and the outlook, what is the company expecting for FY26 and FY27? Now, firstly, if you look at the street coverage here, there are three analysts covering the stock, and all of them have a buy rating. In fact, one of them just upgraded the rating in the recent times, opposed the order win that the company had announced, and the average upside, that is the return potential for the next 1 year, stands at around 17%, which is again a reason for us to give a thumbs up to Netweb Tech.
Well, when you look at the outlook, and I'll also cover the valuation very quickly because they have given a stable outlook, 35 to 40%, and Somit mentioned that if that is sustainable, we'll quiz the management on that as well. That's the key aspect. Apart from that, they've delivered 40% CAGR since listing as well in terms of revenue profile. EBITDA margin is largely maintained at 14%. So that'll be the other thing to watch out for if they are able to maintain their growth. The management has guided for that, but with the new orders in the India AI mission as well, that's going to be the other growth area for the company. When you look at the valuation aspect as well, very quickly, it's not cheap by any means or imaginations. On a price to earning basis, it's trading at 62 times, but that's also for FY27 basis. It's almost trading at 100 times in FY26 basis, and that's why in terms of the current aspect of PE, it is expensive to say the least. Even when you look at the EV EBITDA metric as well, that's largely expensive on that as well. So when you look at the overall rating as well, we'll pull that up very quickly as well, and Somit will take us through all of them right now.
Well, income statement is a thumbs up, balance sheet is a thumbs up again, cash flow and return ratio is quite neutral. So at least 2 out of 4 in the first page. Second one, again, shareholding thumbs up, street cred thumbs up, valuation is down, and street coverage is a thumbs up. So 3 and 2 around, okay, it should be 5, and okay, 2 neutral is 1. So it's around 6 out of 8 is what the rating that we have given to Netweb based on this. Now let's get into our analyst on the show, Renu, Baid, Senior Vice President, Research with IIFL Capital. Ma'am, firstly to start off with, yes, the company has reported quite a strong growth that we have seen of late. But do you expect this growth rate to be sustainable even beyond FY28? Because the recent order wins will lead to strong growth at least till FY27. But what beyond that?
Yeah, hi. The kind of orders that we have seen for the company, especially under National AI Mission, most of these are short cycle executable orders. And while these orders will be completed by the first half of 27, the further new orders should be recurring. So if you look, the total corpus under National AI Mission has been about close to 11,000 crores. And Netweb is pretty much confident that they should be able to garner at least 50% share, which implies 5,000 crores plus of revenue opportunity. So the current order 2 wins that they have announced cumulate to close to 2,100 crores. And just to that extent, we still believe that these are just 40% of the revenues that they are targeting. And the rest revenue momentum from new order wins should continue through FY27-28. In fact, after these 2 orders in second half also, there should be a couple of more order wins, which will drive better visibility for fiscal 27. So in fact, in our revenue forecast, we have taken close to 1,300 crores of revenues from these NAIM orders in fiscal 26 and close to 2,300 crores in fiscal 27, including 1,500 crores worth of new order wins, which will be executed then. While the revenue numbers will taper down from 28-29, nonetheless, it will help better penetration of Netweb solution in India's AI infrastructure there.
Ms. Baid, very good morning to you. Thanks so much for joining in. It's Puneet this side. We've seen you also cover the EMS space very actively, so the high growth is not a concern. But largely, when you look at, in terms of revenue profile, you did mention, what would these new orders do for margins for the company?
Well, since these orders are not just for hardware, but for the entire solution, along with the Tyron software that they offer along on the platform. So to that extent, these are double-digit margin orders. One can contemplate that, yes, compared to the base run rate revenues, where they were earning almost 14% kind of margins, these, given the size and scale, would be at least a few 100 basis points lower. So we still expect that these projects should be between 10 to 11% margins for the company. So on a blended basis, it will not have a significant dilutive impact on the overall margin profile of the company. So we are forecasting about 50 to 80 basis point lower margin than what the company had guided for the base run rate business which was 13.5 to 14% at the end of last quarter.
Right. Just I wanted to understand one thing. I believe by the end of the first quarter, their capacity utilization was around 65 odd percent. So post this couple of order wins, do you expect that utilization levels will increase and they might have to do some more capex on their front or some more hiring on at their end?
So yes, they were operating at 65%, but that was on a single shift basis. SMT lines typically can run 24/7, so easily they can scale up to double shift and if required to third shift. Broadly, there might be some incremental capex of maybe 5-10 crores to debottleneck, add up some more assembly capacities for the servers, etc. But I would say on the capacity front, they are relatively better placed, and that's the reason why they have been able to take these orders with these kind of delivery timelines. So both not just on the SMT line, but also on the other manufacturing activities related to the assembly of the server, they are today well prepared. In fact, the server activities on the assembly side was fully commissioned at the end of 25 itself. So to that extent, they are well prepared to execute this kind of growth rate.
So, just to conclude conversation, I just wanted to understand. So, over FY26 to FY28, what is the kind of growth that you're expecting on revenue, EBITDA, and net profit front?
Overall, if you look in terms of numbers, clearly we are looking at 65% CAGR growth in revenues. Profit CAGR has been 40% plus. But if I look only in terms of AI-driven revenues under the AI mission, so those revenue numbers would be growing almost in terms of absolute numbers. They will add incremental 5,200 crores to the top line. And the base run rate in the AI segment will still be growing at 55% CAGR. So yes, there is a big pop-up which is driven by these national AI mission orders. But yet overall in terms of the growth profile, we don't see any headwinds. So from a profit number which was expected this year to be close to 2.5 billion, we expect the company to really double PAT by 28 to close to 5 billion rupees. So clearly PAT doubling in next 2 years from this year's expectations, and revenue also expected to quadruple thereon.
Right. Well, thank you for joining us and giving us your perspective on the stock that is Netweb Tech. Strong view coming in from IIFL Capital. Now, we also spoke to the management of Netweb Tech to understand how their growth plans or growth plans look like going forward. Let's listen into that conversation. AI segment used to be around 7% of your revenue a couple of years back, which has now increased to around 29% in the first quarter. Where do you see the revenue contribution coming in from this segment, say 2 years down the line, sir?
As I mentioned that, so our AI portion of our revenue continuing to be healthy, and it is, 25 to 30%. And all the missions pertaining to AI mission infrastructure capabilities are being reported and accounted, separately from the revenue segment that you generally see what we submit to BSE and NSE. So entire AI mission related revenue accounting and governance will be done separately. So I think for every such project pertaining to the AI build up is going to be seen as a separate account and separately reported to the market.
Okay, post this order win, what will be your capacity utilization at, I believe in the first quarter, it was around 65% level?
Yeah, so when you talk about the capacity that we are building, right? As you know that we have our in-house motherboard manufacturing, server manufacturing, and all. So we will be delivering these orders in due course of time. Depending on our funnel or even the pipeline conversion basically happens into 6 to 18 months. That is the timeline that is there. So as and when these newer orders that are coming up, we will be fulfilled in due course of time.
Okay, and with this new order wins, will your revenue growth will be much more in FY26, FY27 than what you had guided earlier?
Yeah, so we will obviously, so with these larger orders coming in, obviously it is natural that our revenue growth is going to be much faster compared to what has been there in place, and we anticipate some more other orders which are there in the pipeline will also mature during the course of time. Yes, obviously this will translate to a better revenue as we move forward.
Right, sir. Just wanted to understand the tie-up that you have with Nvidia. How does that help the company? Does that add more credibility and helps in securing orders faster?
So we have been working with all of our ecosystem partners, from a very strategic perspective, whether it is Nvidia, from the GPU server perspective, or AMD or Intel. Now, having said that, our relationship with Nvidia is deep rooted, while Netweb is one of the 6 global manufacturers of GPU servers based out of India, and we are the only one in India. So we do have the technology relationship with them. We get to understand their, the systems and the softwares that are required to leverage the underlying platform better, and that relationship really helps us to delivering outstanding capability much faster and time to market as they are launching their new generation solutions. And that is the way Netweb and Nvidia works in tandem to help build these kind of solutions. By the time they launch their newer GPUs or newer software stack that is available on the Netweb built GPU servers as well, and that basically really helps. That technology association really helps us, making these solutions, bringing to the market faster, and that also convinces our customer about our joint value proposition and how that translates to their business success.
Well, that was the management of Netweb. You also got the analyst view in this particular episode, so you got the twin benefit as well. But thanks so much for tuning in to KYC. Lots more action on the other side. Stay tuned to NDTV Profit.